Yeah.
Sometimes we can buy a business that's been out of stock about 25% of the time, and we can grow the earnings a third by just making sure that there's enough working capital to make sure that that business stays in stock.
Are you ready to transform your life? This is a no-nonsense show helping immigrants like you create generational wealth, even while working full-time. Get ready to take notes. Here's your host, Saket Jain.
Welcome back, my Great to Wealth listeners. Today, I have the pleasure to bring to you Mike Vranjkovic. I'm very close to pronouncing his last name right. I just can't pronounce the last name right for this complicated a last name. But Mike's dialing in from Colombia, Medellin, Colombia. And why I thought it's an interesting conversation today is really going to be, I know most of you probably already know I have my own venture capital fund. And I love investing in businesses, especially that are cash flowing. Now, venture capital is not necessarily a cash flowing end of it. But what Mike does is he does a micro private equity, which essentially would mean that he'll raise capital just like a private equity fund will, and then go buy businesses and then turn them around and potentially sell them. And that's really how the money. So we'll talk about the entire business model. I really thought where we are in the economic cycle, people are getting nervous around real estate while they shouldn't. But the plan was to give a little bit more options on if not real estate, if not venture capital, if not this, what else? So this is one more tool in your arsenal to try and see how you can use that. So that's really how I would ask you to take a listen to this podcast, or if you're watching on YouTube, watch this podcast. It's going to be with that angle, that one more way of investing passively with cash flow. With that said, Mike, welcome to the show. Appreciate your time, buddy.
Awesome. Thank you so much for having me on here today. And the pronunciation was perfect.
Awesome, man. Perfect. So we won't go too much of the intro beyond what we just talked about. We're going to jump directly into the podcast here. And through the podcast, we'll uncover your story. The one way we like to start the show is when you hear the term migrate to wealth, what does that mean to you?
Well, I actually looked up a little bit more about you before the podcast, just so I could know what to focus on. But I think it's really interesting. I've never seen a podcast like this focused primarily on first and second generation immigrants, which I thought was really cool because I'm an immigrant myself. I moved to the U.S. when I was 12 years old. I spent most of my life in Chicago, and now I'm living in South America.
That's awesome, Mike. Mike, so let's jump into that story. Where did you immigrate from?
So I was born in Serbia. When I was 4 years old, my family moved to Germany. So I grew up in Germany. And then when I was 12, moved to the US and spent most of my life there.
Awesome. And that was in Chicago, you said, right?
Correct. Chicago area.
Chicago area. Perfect. So Mike, help us understand your journey into wealth, right? Kind of like how you looked at, and I don't know if you can go back as far as 12 years old, or whatever is your earliest memory of wealth, right? And wealth could mean a lot of different things to a lot of different people. For some, it means freedom. For some, it means education. For some, it means relationship. For some, it means all money. For some, it could mean everything. But I don't think there's any one definition of wealth which is correct. It's just different definitions. So when you go back in time to your earliest memory of wealth, what did that mean to you, especially as you've moved 3 major countries? And for, I'm assuming, not by choice. At least some of the moves may not be by choice. So how do you reflect back on that? And tell me a little bit more about that.
Yeah, I mean, all the moves that I've done up until recently, they were my parents' decisions. So we moved, and I was young, and I didn't have a say in it, and I should have not had a say in it. At 4 and 12 years old, you probably don't make the best decisions. So when I was younger and I didn't know any better, my definition of wealth was high income. And that's what I did out of college. Out of college, I went into finance. I worked for a derivatives trading firm in Chicago. It was a great experience. Got to work with some really smart people, and it was really fun. At some point during that time, I was there for about 5 years. I realized that wealth doesn't necessarily, at least in my opinion, just equal high income, because you're trading time for money. I realized that if I go take 2 weeks or a month off or whatever, I'm not making any money during that time. So what I really wanted to do for the next part of my life was have assets that are generating income and that are creating income even when I'm sleeping and when I'm not working. And the industry that I decided to go into was these online businesses. So after my finance career, I ended up working for a startup, actually a brokerage that buys and sells these types of online businesses. Went on to create my own online business, and about 3 years ago, we founded WebStreet to solve a similar problem for other people.
So, Mike, let's go through that. Let's break it down. There's a lot of different insights right in there. So you picked finance, you did derivatives trading, which is highly intellectual work, right? And then it's very left brain. And then you decided, hey, you know what? I need to find independence through passive income. So how did that talk to me about that process? How did you find from trading to online businesses? Not a logical jump. So help us understand, how did you decide on picking investing in online businesses as your way to earn passive income? Why not real estate? Why not any of the other ways to do that? Help me understand that.
Well, the most interesting thing about online businesses is the multiples for which they trade for. So you can buy a cash flow positive online business for roughly 3x of its earnings. Okay. And then also with some of these smaller.
And when you say earnings, Mike, are we talking about EBITDA? Are we talking about revenue? What are we talking about?
EBITDA. So basically profits, 3x profits.
Got it.
So that makes online businesses a really attractive investment. Now, of course, it's not that easy. The two things that make it highly difficult are they're not passive investment. They're highly actively managed businesses. Oftentimes there's inventory, there are employees, you need a specialized skill set to run them. And then with online businesses of a certain size, there are many single points of failure. So it's not a great passive investment, and that's the problem that we set out to solve with WebStreet.
Got it. So now let's go a little bit deeper into that. So you set out to create financial independence through online businesses. So before you launched WebStreet, how did that work out for you? That creating the passive income. Where were you in that journey? Yes. Were you able to successfully create it, or you realized that you have to get actively involved to learn the business to then generate passive income? What was the process?
So I actually had a few stepping stones. So while I was at my finance job, I was trying to figure out what to do next. And I randomly, I started researching these online businesses. Honestly, at first sounded like a scam. Like, there's no way people make money online with websites. Yeah. This has to be some kind of scam. Like, this is worse than many other things. And the more I looked into it, the more interesting it seemed. And I thought I was really onto something here. And I ran across this job post for an internship on the other side of the world in Southeast Asia, a very low paid internship, but it was for a new small company that was a online business brokerage. So a place that sold these online businesses. And I figured, if I eventually want to buy my own online business or build my own online business, why don't I work for a brokerage? I'll figure out the patterns. I'll see what works, what doesn't. And I joined the brokerage. It was an amazing experience. I had a front row seat to some incredible growth. When I joined, there were only a handful of people, me and the founders and a few employees. And by the time I left, it was about 100 employees, the world's biggest brokerage for online businesses. So as a result of that experience, I got to see, a nice overview of what type of business models work online, what type are more difficult to run, which have more risk, which have more upside. And then I ended up leaving and creating my own online business. And that's what eventually built the passive income.
Oh, I see what you're saying. So now I understand that. So you went from You still were trading time for money, but more in the direction that you really aligned yourself with, because you had picked your asset class that you want to build expertise on. And then you went deep into that, understood it, then you launched your own online business, which then created passive income. Is that correct?
Correct. But when I launched it, it definitely was not passive at all.
I can imagine.
It was 80 hours a week for a year or two. And then after a couple of years, it eventually got to the part where it's a passive business. I mean, it's an e-commerce business. Currently, I spend about an hour a week on it, and basically at the board level strategy.
So, Mike, for people who don't understand online businesses to the level that you do, can you break it down for them? What does an online business mean?
Yeah. So very simple, just like a brick and mortar business, except all of its operations are online. If you're in the US, you probably interact with online businesses all the time. So the one that most people are familiar would be a e-commerce business. So when you go to Amazon and order something, more than 2/3 of the products that you're buying on Amazon are from third-party sellers. It's not actually Amazon manufacturing the products. Those are other brands, and many of those brands are small and medium-sized businesses. And that's actually the type of business that I created. Another great example would be a website. Let's say you go online, you're looking to buy some luggage, and you type in, best checked luggage 2023. You land on a website. It has a bunch of different reviews of different types of luggage, and then it has links either back to Amazon or directly back to the website. That website makes money through those links. So that would be an online business. Another online business would be any type of software tool that you use that you pay a monthly recurring subscription for. That would be an online business. If you buy a Kindle book, or even if you buy a printed book, oftentimes that would be an online business as well.
Got it. And Mike, what is your online business, if you don't mind me asking?
Yeah, absolutely. So mine is a product, it's a private label product that we modified to serve the ketogenic market. So people that are doing a keto diet, it helps them. So the way we got started is we were reselling other people's products, and we kind of noticed that they're not ideal for our market. So we went to a manufacturer, we had them modify it and custom create a product for a very small niche of the market.
So it's for cattle, you said? Like cows and
no,
stuff?
No, sorry. It's for the ketogenic diet.
So ketogenic diet. Got it. Okay, now
correct.
You said
correct.
keto. Okay, now I understand it. Okay, for cattle, that big of. I'm sure that market is big too. Okay, I understand that now. So I think that makes sense. And this is a supplement, or this was a food product?
It's a tool. So it's basically like a fitness tracker.
Got it. Okay, perfect. So Mike, now let's go into the second part of your journey. So now you got to a point where you were able to create passive income. What was next for you at that point? Was that the impetus for you to launch the company that you launched for passive investments?
So basically, I was at the point where I was earning enough passive income and working very. It didn't take very many hours every week to maintain that income, and I stayed in touch with the two founders of the company that I used to work for, the brokerage. And I remember one question that we always heard when I was working at the brokerage was, I love the idea of online businesses. 3x annual profits seems incredible. The ROI on that is good, but I have no idea how to run these online businesses. I don't have the specialized skill set, or I don't have the time, or I don't have any interest in doing this. How about I just buy a business and you guys run it for me? Or can you find me somebody that can run these businesses? And we've heard that over and over so many times. And then, we sat down one day and we figured, well, why don't we do exactly what, our customers have been asking us to do for years? We've got all the right skill sets. We've got all the right tools in place to do this successfully. And there wasn't really anybody out there that was doing it. So I partnered with my former bosses from the brokerage, and now we're partners on this new standalone business.
And what is that? Tell me more about this new business.
So the new business is webstreet.co. It's a investment platform for people to passively invest in cash flowing online businesses.
Perfect. And so let's say I'm interested. What's available on the platform? Am I just giving into a blind fund, or am I saying that, hey, I want to invest in Mike's business but not in Saket's business, or vice versa? How does that work? Help me understand that.
Yeah. Good question. So we launched this business, this investment fund, about 3 years ago. It's gone through a few iterations based on our investor feedback and based on our returns. So far, we've raised about $30 million from about 400 investors. We've used that money to buy 40 different assets across 5 different investment funds. What we do now, every 3 to 6 months, we'll launch a diversified investment fund. It's only open to accredited investors currently. So US definition, million plus net worth, or 200K plus income. And when you invest, you're investing at the fund level. So you won't be able to pick and choose what businesses. And the reason we do that is diversification. So we'll go out and raise a $5 to $10 million investment fund from a few hundred investors. And then once that money is raised, we go out and put together a diversified portfolio of 10 to 15 online businesses run by different portfolio managers, run by different operators.
Got it. And how do you find these operators, Mike? Because I'm assuming you're not operating it, or your brokers are not, or your broker partner.
No. So that's the nice part about the connection to the brokerage. So my two partners on WebStreet, they also own Empire Flippers, the biggest brokerage for these types of online businesses. And the brokerage has sold over 2,000 of these online businesses. And a lot of the sellers are repeat sellers. So in many cases, the brokerage has vetted their track record. They've built the P&Ls on these businesses. So they have a very large audience of online business operators, builders, buyers, sellers. And a small percentage of that audience makes our ideal operators. And what we really try to do with WebStreet was line up everybody's interests. So the way the operators are paid, they don't draw a salary. They receive a part of the profits. The investors receive a part of the profits, and WebStreet receives a part of the profits.
Got it. And Mike, how does one assess the risk of, how do you evaluate an online business? For somebody who doesn't know, I mean, most of the audience would definitely know how to look at a real estate deal. At least they have a perspective on that. They have a starting point, but evaluating an online business, most people won't even know, right? Because that's a specialized skill.
Yes, some of it is very similar. Some of it is unique. So the similarities are they're typically valued based on earnings, bottom line, free cash flow, whichever metric you want to use, and then you apply a multiple. Right now, the industry multiple is roughly at 3x, but we've bought anything from 2x annual to 4.5x annual. So that's the basic calculation. And then, of course, the stuff that requires more specialized knowledge is properly assessing the risk. So what is the probability of the earnings continuing at this level? What's the likelihood of the earnings going down? What can I do to grow this business? How much investment will it take? What's the probability of that working?
And are you buying turnaround potentials, or are you buying businesses that don't necessarily are distressed? How are you looking at
no. So we don't do anything distressed. We only buy businesses that have steady or growing earnings. And all of the businesses that we buy are cash flow positive. So we don't buy turnarounds. We don't buy pre-profitable or pre-revenue companies. Only businesses with solid earnings. It makes it a lot more.
Go ahead.
Oh, sorry, go ahead. It just makes it a lot more interesting to investors. There's opportunity to do that, but that's not something that we're doing.
Yeah, I don't think that makes sense. And Mike, what's usually the hold time for these businesses?
So our hold time is 2 to 4 years. So probably average right around 3 years. If you're part of a fund, that fund might have 10 to 15 businesses. Some might sell later, some might sell sooner.
Okay, that's perfect. And then how do you manage the risk on your end, right? So kind of like when somebody invests in a fund, they definitely don't know. I mean, they may know the businesses that you have invested in, but they don't have the day-to-day insight into what's happening there. How do you oversee that whole operations to make sure that whatever is going on is still in the best interest for all the stakeholders involved?
Yeah, that's a really good question. So there's basically two components to it. So the first one is picking the right portfolio managers or operators, as we call them, the people that run the businesses. And then the second component is buying the right businesses. So for the first part, what we look for is we look for highly experienced portfolio managers that have their own portfolio of assets, and we have them put together a investment criteria that is exactly on what they've been able to do successfully. So, for example, we have a guy that has probably about 20 websites in his portfolio, and for our fund, he's going to receive about 20% allocation of the fund, and he's going to buy 3 websites, and the websites will have the exact same opportunities and risks of the types of businesses or the types of websites that he's run in the last 10 years. And what we do is we vet their track record. So we look at their P&Ls of businesses that they've sold. We look at their growth strategies, we look at their maintenance strategies, and so on. So the first piece is finding the right operators. And we typically like to work with repeat operators. So on our current fund, we have 4 operators, each with a different business model, and 3 out of 4 operators are repeat operators. So we can draw on past returns. We can say, hey, this operator has delivered 15% trailing 12 months on a previous fund. This is a new operator. This is how his portfolio has done. And then the second piece, the second part here is buying the right types of businesses. We already talked about that a little bit, but we don't buy anything turnaround. We don't buy anything declining. We buy businesses that are steady or growing. And then the most important piece for the acquisitions is buying a asset that perfectly ties back to the operator's experience. Let's say we're buying a website, and let's say the operator has deep experience in conversion rate optimization, basically squeezing more revenue out of every user that visits that website. Well, those are the types of opportunities that we're going to look for, because they can successfully evaluate a potential target and say like, okay, I have 5 other assets like these. This is the baseline of what this business is making now. I think on average, I can grow this by 10 to 15%, and we can build that right into the model before we even make the acquisition.
Yeah, no, I love that, Mike. So, Mike, when somebody is investing in your funds, do you know these operators beforehand? Like, how do you build your thesis, or you find the businesses and then find the operators? What comes first?
Yeah, so operators come first, then investor money, and then the businesses. So basically, when somebody comes to Web Street and they're looking to invest, they'll see all the operators in the fund, they'll see the allocation by business model, and then they'll see a full write-up on the operators. They'll say, this guy's been doing this for this many years. This is what he currently has in his portfolio. This is the performance of his existing portfolio. We'll have information if they've done any other funds in the past. And then we'll have the investment criteria of what they're looking to buy. After we raise the money, the operators have 90 days to make acquisitions. We have oversight on the acquisitions. We approve all the acquisitions. Any unspent money gets sent back to investors.
Got it. So I think that was going to be my next question. That what if within the 90-day window, they don't find the right opportunities? At that point, the investors get their money back, and is it pro rata?
Correct. So we never deploy 100% of the raised capital. Our average is right around 80%, and we always err on the side of returning capital. We actually have it sitting in a T-bill fund, and we pass on the interest to investors. So sometimes it's frustrating to receive a refund of your investment amount, but we always err on the side of protecting downside. So investors receive a pro rata refund based on how much they invested.
And Mike, how does that work? Some businesses may need capital, right? So let's say you buy a business that I run, and you think if you can inject another $1 million into the business, the growth is going to be 10x. I'm making it up. I don't know what the right numbers are. So how do you know beforehand how much to carve out for these businesses, especially if it's in a fund model? How do you make the determination, and how does that impact the investor?
Yeah, good question. So we don't have any capital calls for investors. So you won't get a email 6 months from now asking you to send more money. So whatever you put in upfront, that's all the money that's expected. When we look at acquisitions, we do a cash flow analysis, including the growth plan. So before we even buy a business, we build a growth plan, and then we calculate how much money is needed to properly execute on that growth plan, and we set that money aside. But you're absolutely right. Some businesses need a cash injection to be able to grow. E-commerce businesses with physical products with inventory are a perfect example. Sometimes we can buy a business that's been out of stock about 25% of the time, and we can grow the earnings a third by just making sure that there's enough working capital to make sure that business stays in stock. So this is something that we can calculate and project at the beginning before the acquisition, and then we set that money aside, and we build in a little bit of buffer in case something unexpected happens. And after 2 to 3 quarters of operating the business, if our working capital buffer is too big, we send that money back to investors.
And that gets back to the investors. As I love this now, Mike. Now I'm doing a one-on-one consulting with you. That I'm interested in learning more about it. So I'm like, now let me go deeper into that. I think we've gone past the podcast time right now. But this is perfect. I love this.
That's all right. That's all right. I love talking about this stuff.
So when you're buying this thing, right, and are you returning the capital as return off capital or return on capital at that point when you're returning people's money back?
So both. There's 2 components. So every quarter we distribute all the profits. So I would probably consider that return on capital. We've been able to do about 15% cash yield. So basically, whatever money the business makes in a quarter, we distribute that to investors. And then when we sell the businesses, we return the capital. Then it would be return off capital. And then oftentimes there's also profits from increase in value if we've been able to execute growth. So right now we're doing about 15% cash yield, and we're on track for about 20% IRR across a diversified portfolio.
Got it. Okay, perfect. And what about the other component of the deal, Mike, in terms of tax savings? Because you're now investing in businesses, right? So there's going to be depreciations and write-offs because it could be inventory, it could be equipment, it could be whatever, depending on the business, what it does. Are there any tax benefits, especially for the U.S. audience?
Unfortunately, not really. So if you're coming from a real estate investment background, the depreciation or the amortization is just not the same, and you can't do what do you call them, 1031 exchanges?
1031s, yeah.
Unfortunately, you can't do that with online businesses. We've tried to look really, really hard. We haven't found a way to do it. So the tax savings are not as good. Of course, we'll pass on any amortization or depreciation to investors on the K1s, but it's not as substantial as what you would see with real estate investing. The flip side of that is we have a lot of real estate investors that are also investing in us, and some of the really sophisticated investors are using our platform as a hedge for commercial real estate. So some guys have a little bit too much commercial real estate exposure. They're seeing the trend of people moving outside of city centers or working from home, and they're using that to hedge their portfolio.
Got it. I think it's all about diversification to begin with. So I love that, Mike. And Mike, how long have you been running this fund now, Mike?
3 years, almost 3 years.
Almost 3 years. Got it. And how many funds have you guys launched already?
So we are on fund number 6.
Fund number 6. So I'm assuming you basically launch every 6 months approximately. You launch a fund.
Correct. Every 3 to 6 months.
3 to 6 months. Okay. And then usually each fund will have how many businesses, or does it change?
It varies. It varies based on the monetization, but I would say typically 10 to 15 businesses.
10 to 15 businesses. Okay. And do you ever have repeat operators in multiple funds? Or once
absolutely. We have a fund open now. I'm pretty sure it'll be closed by the time the podcast is published. But we for our current fund, 3/4 of our operators are repeat operators. So typically we'll have about half the operators be repeat operators, and that's something that we've gotten lots of interest from investors, and it just makes it easier for us to vet the operator as well. Yeah. It's we're getting a known quantity.
Because they've already showed their performance, right, on the fund. So that's always helpful.
Exactly. Okay. And even if they're new, we look at the performance of their portfolio, but just having them in a previous fund makes things much easier.
Got it. Perfect. Mike, we're coming towards the end of our show here. So a few last minute things here. One's going to be, is there any question that you wish I asked you that I didn't that would add value to the listeners?
Oh, that's a really good question. Let me think. I guess we didn't really talk about the risks of online businesses. So the biggest risks are, it's a very niche market, niche industry. So if you're, basically if you want to participate in online businesses, you have the option, assuming you don't build one yourself, you have the option to buy one. If you go that route, make sure that you fully understand the work required and the skill set required. If you go the passive route, then like we talked about, it's important to make sure that you have operators that have that knowledge and experience. That's about it. That's everything I can think of.
Perfect. And Mike, so we're changing the next segment of our podcast here. So we're going to ask a question is, there is a 20-year-old Mike somewhere listening to the show. What's going to be one insight from you to that 20-year-old Mike that could help them tremendously in consciously designing their migration into wealth?
Yeah, I would say try to get to the point as quickly as possible where you're trading time for knowledge and skills versus just time for money. Yeah. That took me a while to figure out. And then, of course, get to the point where you're building enough assets that are creating passive income.
Yeah, love that, Mike. Mike, next question here is, it's a little bit more philosophical question, but it's gonna again, there's no right answer. Where do you believe that humanity as a whole should migrate to in the next few years, next few decades?
Wow, that's a big question. I mean, generally, I try to be positive. Sometimes you see these news stories about risks, whether that's AI risk, whether it's environmental risks, whatever the case may be. But I think I think we're very resilient. I think we're going to figure stuff out, and I try to keep a positive view. That's not very specific, but it's just kind of a general operating principle.
No, I think that's really the optimism is the key, right? Because things are never going to happen the way you plan them to happen. Especially if you're depending on the external world, it'll never happen the way you want it to be happening. But if you can manage your internal optimism, at least you have the perseverance to go through those tougher times. So I think that answer definitely resonates with me. Mike, where can people learn more about you? Where can they find your fund, information about your fund, and hopefully connect with you?
Yeah, best place is our website. The URL is webstreet.co.
Webstreet.co. We'll make sure that gets included, Mike, in the show notes below. Mike, I really thank you. I appreciate your time. I know you probably do these podcasts a lot, so it's probably repeated information for you. But for our listeners, I think it's a great way of diversifying their portfolio by listening to someone like you and kind of learning more about the online businesses. Again, nothing comes without a risk. A big disclaimer. You have to do, as a listener, you have to do your own due diligence to make sure that you understand what you're buying into. If you have your own advisors, make sure you consult with them. Don't take anything that we say on this show without a grain of salt, because what Mike and I are doing and other guests are doing, we're sharing our perspectives, our insights, and something that we do does not mean it's right for you. So you have to do that analysis yourself. So once given that disclaimer is out of the way, I want to thank you, listeners, for being, if you're listening to this part, that means you stayed with us till the end. So thank you for listening to the show. Appreciate it. Without this, it won't be possible. Keep tuning in. We'll see you next week. And Mike, thank you again for your time.
Awesome. Thank you so much for having me on here today.
If you got value from this episode, you might consider sharing this content with a friend. But most importantly, be sure to take action on what you've learned. One way you can take the next step is to connect directly with Saket on an investor call. That link is waiting for you in the show notes below.